Food prices to stay high. Cooking oil to stay on the boil. High fuel prices weigh on inflation. Slowdown in global demand. COVID lockdowns in China threaten world economy.
Based on this assessment of the macroeconomic situation and the outlook, the Monetary Policy Committee voted unanimously to increase the policy repo rate by 40 basis points, 40.
A massive 40 basis point hike, the first one since August 2018. The decision, taken unanimously by the central bank's high-powered Monetary Policy Committee at an extraordinary meeting on Monday and Wednesday. The hike ends a 44-month period of low interest rates and an accommodative stance by the RBI. But with inflation spiking and the consumer index rising to a 17-month high in March, the RBI was forced to go in for an out-of-turn interest rate hike even before its next scheduled review in June.
The MPC judged that the inflation outlook warrants an appropriate and timely response through resolute and calibrated steps to ensure that second-round effects of supply-side shocks on the economy are contained and long-term inflation expectations are kept firmly anchored.
Even the RBI concedes to what the entire nation knows. It is wildly spiraling food prices which has sucker punched the Indian consumer. And if you expect any relief soon, don't. The central bank listed a litany of reasons why prices may not soften. From global crude oil prices, which have been stuck above the $100 level since February, to a shortage of wheat and other staples due to the Ukraine war. Cooking oil prices, RBI says, will remain high. There's even a spike in prices of fertilizers due to falling supply. Lockdowns, particularly in China, have disrupted the supply chain all over the world.
The risks of unprecedented input cost pressures translating into yet another round of price increases for processed food, non-food manufactured products and services are now more potent than before. This could strengthen corporate pricing power if margins get squeezed inordinately.
In addition to hiking the repo rate, the RBI has targeted inflation by sucking out 87,000 crore rupees in liquidity by hiking the cash reserve ratio, an amount banks need to keep as deposits as a proportion of the loans they give.
Keeping with the stance of withdrawal of accommodation and in line with the earlier announcement of gradual withdrawal of liquidity over a multi-year time frame, it has been decided to increase the cash reserve ratio, CRR, by 50 basis points, that is 50 basis points to 4.5% of net demand and time liabilities.
The RBI has allayed fears that the rate hikes will hit economic growth. Higher cost of loans normally discourages companies from borrowing and usually hurts the GDP growth rate.
It is reiterated that the RBI will ensure adequate liquidity in the system to meet the productive requirements of the economy in support of credit offtake and growth.
The central bank's midterm surprise is expected to be just the first hike in the coming months, despite it maintaining its accommodative stance. But with galloping inflation showing no signs of slowing down, the RBI could soon abandon all accommodation and turn into a hawk. Bureau Report, Business Today Television.
Joining me now, Madan Sabnavis, our Chief Economist, Bank of Baroda. Madan, great to have you with us, and you've been closely tracking the developments and the expectations of the RBI moving on the rate front. But this came as a big surprise, particularly to markets, out-of-turn rate hike that we saw today. What was your reaction? What do you feel are the key takeaways? How would you read between the lines here?
In fact, none of us really expected the RBI to take any action until June, because in April, during the policy, it was very clearly stated that the stance would remain accommodative, though there would be a gradual withdrawing of accommodation. So I think the way the RBI governor has put it today is that the repo rate hike and the CRR hike are part of this entire process of withdrawal of accommodation. But what this really means is that the RBI has taken a more stern view on inflation. And all this while it was a case of saying that, look, inflation is high, but we can still wait because we do expect it to stabilize at some point of time. But today it looks like that the very fact that the MPC met 1 month after the earlier policy, the last policy in April, and unanimously voted for increasing the repo rate, it really means that they do think that inflation is going to be a major problem for us going ahead. And not just inflation because of food or fuel, I think it's very much broad-based. So I think that's what the RBI governor has pointed out. The manufacturers are passing on higher raw material costs, fuel prices are already high, food prices are going up, and notwithstanding the fact that we're expecting a good monsoon, there could be an increase in MSPs coming, which would again further add to food prices. So I think generalized inflation is the major concern of the Reserve Bank of India today. And the feeling is that if we do not try and address this issue today, it could be affecting consumption going ahead, and which in turn will also affect investment and future prospects for growth.
So, Madan, are you thinking that there are going to be further hikes given the scenario that you've just described? What would you expect or anticipate from the RBI in the coming few months?
Absolutely. I think there would definitely be another 50 basis points increase in the repo rate during this calendar year, which can go up to 75 basis points. So we could be ending at around 5 to 5.15% by March 2023. This is because as long as inflation remains elevated, and it looks like that it's going to be in this region of 7%, which is very, very uncomfortable for the MPC for some more time. So therefore, we could brace up for more increases in the repo rate, and hopefully it will be in a calibrated manner of 25 basis points each time. But given the surprise which we had of 40 basis points, I wouldn't really be surprised if we have another 50 basis points increase in June too.
All right. Now, talking about inflation, and what was really worrying in the governor's speech were the frequent warnings on food prices. There are clear indications that the situation could get much worse, as Madan has also just alluded to. In fact, the RBI governor listed out various reasons. Let's listen in and then we'll go back across to Madan Sabnavis.
The sharp acceleration in headline CPI inflation in March 2022 to 7% was propelled in particular by food inflation due to the impact of adverse spillovers from unprecedented high global food prices. 9 out of the 12 food subgroups registered an increase in inflation in the month of March. High frequency price indicators for April indicate the persistence of food price pressures. Simultaneously, the direct impact of increases in domestic pump prices of petroleum products beginning the second fortnight of March is feeding into core inflation prints and is expected to have intensified in April. Looking ahead, food inflation pressures are likely to continue. Food price indices of the Food and Agriculture Organization, that is FAO, and the World Bank touched historical highs in March and remain elevated. Spillovers from global wheat shortages are impacting domestic prices even though domestic supply remains comfortable. Prices of edible oils may firm up further due to export restrictions by key producing countries and the loss of sunflower oil output due to the war. Elevated feed costs are translating into escalation in poultry, milk, and dairy product prices.
All right, so that sets the context. Madan, what is this going to mean for consumers? Everything is bound to get more expensive, of course, but also we're going to start to see some uptick on those fixed deposits. Overall, net, I mean, how worrying is this going to be for the end user?
Actually, it all depends upon whether we are a saver or whether we are a borrower. So I think for savers, it will be a big relief because a big increase of 40 basis points in the repo rate will automatically lead to increase in deposit rates. Maybe not commensurately, but probably to maybe 10 to 20 basis points uptake is something which one could see. But if you're a borrower, and I think that is something which has really picked up in the last couple of years, because as long as we had this easy money policy, we saw that the retail loans were the ones which actually propelled overall bank credit growth. And today, if you're looking in terms of home loans, they're going to get more expensive because your AMIs are going to go up. If you're an SME where you're borrowing funds from banks based on a benchmark, which is the repo rate, you automatically end up paying 40 basis points higher. So overall, I think the borrowing costs will go up. So as far as banks are concerned, given the fact that the deposit rates rise at a lower rate than the lending rates, it could be good times in terms of the NIMs for banks. But of course, for them, the counter would be that treasury income, which has helped their P&L accounts for the last couple of years, will no longer be robust. In fact, they may have to book certain losses. But in net terms, I think banks would be gainers on account of this. Borrowers will have to pay higher costs, and savers will probably benefit to a certain extent, though not to the same extent as the repo rate increase.
All right. So clearly, a hit if you were planning to take out an EMI, and also, as Madan mentioned earlier, investment plans may also take a back seat going forward. We'll have to see how this pans out. Madan, how much of this was preempted because everyone's expecting that massive hike by the Fed coming in post this time's meeting?
Actually, the timing is such that it's been timed between two policies, and MPC met and took a decision just before the Federal Reserve took a decision. So I wouldn't like to read too much into it, but definitely there's a case of saying that we have seen that FPIs have been negative so far for as far as India is concerned, and the fact that the Federal Reserve is almost definite to increase their rates by 50 basis points. I think that itself was an indication that probably something had to be done by the RBI. So I would say that while inflation has been the primary driver, somewhere in the background, the RBI is also concerned, the government is also concerned with the fact that we need to make sure that there is some alignment between what the RBI does and other central banks, because even the external account is something which one has to look at. So I think the way we should look at the overall rate change which has been invoked today is that from a stage of looking just at inflation, shifting over to growth during the pandemic time, we're back to looking at inflation with an additional responsibility of also seeing how monetary policy could affect the external account, that is the overall balance of payments. So I think that's how I would look at it.
Sure. Madan, on growth though, and given that while the RBI may have had to consider some of these factors, and prioritize for the moment, when we talk about growth, what is the kind of impact that's likely if we're looking at 40 basis points now and another 50, as you said, coming soon?
Yeah, overall growth will definitely get affected at a margin. But I think that it was a case of balancing two things. That do I let inflation go run amok, which could be affecting overall consumption? As your consumption power comes down, you spend more money on necessities, discretionary consumption gets affected, which in turn affects investment. Or alternatively, you follow a policy of saying that, look, I'm going to increase interest rates. Definitely at the margin, as far as industry is concerned, investment is something which would slow down. Only those sectors which see a vibrant demand would go in for expansions, given the fact that RBI has also mentioned that there's been an improvement in capacity utilization. So therefore, we could be expecting investment to be positive, but it will not be broad-based. It will be across certain sectors which are not going to be affected by this entire process of war, inflation, and rate hikes. But on the whole, yes, growth is there's going to be some kind of a downside to growth. And our estimate is that there could be a downside of around 25 basis points. So we at Bank of Baroda had a forecast of around 7.4, 7.5% last month on GDP growth. So this could go down by around 25 basis points based on this 40 basis points plus another 50 basis points during the course of the year.
Madan Sabnavis, thanks so much for joining us on the show today. Great to have you with us, taking a closer look at the RBI policy.
If you like the video, do like, comment, share and subscribe.